Hey internet folks, everyone else and their dog is making videos about the AI bubble, so I thought I'd jump into the fray here with my perspective because I think that most videos are missing a huge amount of nuance. Alright, now the word nuance scares or bores a lot of people, so let me set some expectations right now. AI is here to stay. It's already paved a highway into your economic future, and there's absolutely nothing you can do about it. Now, 2 years ago I made this video, not one of my best, where I stated that in the late 1990s and early 2000s in the financial industry and in forensic accounting, we were already using primitive AI tools that proved enormously useful. By sometime in 2013, with the success of the National Reconnaissance Office's Sentient Initiative, the age of AI dominance had already begun. The public just wasn't aware of it yet. Now, this video isn't going to be a long, drawn-out technical explanation about the new age of AI or why I believe we're in an investment bubble. We are in an investment bubble. Most economists agree. And a lot of billionaires believe that the bubble is going to burst soon and they're building bunkers literally, not figuratively. Hysteria aside, I think that it's probably best to compare the current AI bubble to another large historical bubble. The best comparison where the data and the living memory of that bubble is still accessible to younger investors today is going to be the dot-com bubble of the early 2000s. You're able to access people who lived through that right now. The bursting of the AI bubble is likely going to go by the same playbook as the dot-com bubble, but on a much larger scale because the scale of investment is much larger. Like Mark Twain maybe famously said, history doesn't repeat itself, but it often rhymes. When the economy slows, and it's slowing right now, money is going to rotate from expensive tech stocks to unloved value laggards of today, most likely heavily skewed towards financials. So why is the dot-com bubble the best comparison? Why do many experts think that conditions are reminiscent of the early 2000s? Well, a lot of it has to do with where we are on the technology adoption curve and how investment is allocated across the stock market. So just like in the early 2000s, when the internet wasn't exactly new, but public awareness of it was, we've seen a high degree of overinvestment in the field of AI, and we see a lot of bad investments in AI. Now, just like the dot-com era, there's a lot of investments that look very promising today. But the very first time that they are tested by a decline in investor confidence, they're going to fail and the stock is going to be completely worthless. This is because we're pretty much right in the same spot on the technology adoption curve that we were during the dot-com boom. If you're a younger investor who just started investing anytime after 2008, you should talk to an older, maybe retired financial professional to gain some perspective about the early 2000s in order to understand how similar it was to the AI boom of today. Today, any company with AI in their name or any company that announces the integration of AI automatically sees a bump in investment. This is exactly what happened with any company that had .com in their name in the early 2000s. Every company that was an internet company was going to make you a millionaire if you just bought some of their stock. Well, the internet, just like AI, was going to change everything about our lives, and everyone who could afford to buy a share of stock knew exactly how that was going to happen. If you just threw buckets of money at anything with .com in the name, you were going to be rich because of how transformative that technology was. Then the bubble burst. Probably 95% of .com investments failed to meet expectations or went to zero. The 9/11 attacks did not really have that much to do with the collapse of the .com bubble. That was just the black swan event that triggered everything. But the internet, as a technology, did not fail at all. No, it really was transformative. It really was a revolution. The internet is embedded in our lives in ways that were hard to imagine in the year 2000. That transition simply didn't happen the way that the vast majority of investors expected it to, and the result was that most investors lost money from 2000 to 2002 when the S&P 500 was down 3 years in a row by 9, 11, and 22%. The vast majority of investors today have never experienced a bear market this long, even those who were invested through the 2008 Great Recession. That literally by January 10th of 2009, the market was already recovering, and it's continued to recover since then with just a few interruptions. The lesson here is that every single technological revolution results in an investment bubble, and every single technological revolution subverts the expectations of investors. There are few survivors, and it is completely normal in a capitalist economy that there are few survivors. There just isn't really a way to predict winners. So what am I doing to prepare for the inevitable bursting of the AI bubble? Now, as I've stated many times in the past, the vast majority of my portfolio is invested in index or sector ETFs, and roughly 30% invested in individual stocks. I like to take risks. In fact, you can say that I have an exceedingly healthy appetite for risk, but there's only one thing that I like more than risk, and that's a good bargain on risk. As you longtime subscribers know, I am typically a buy and hold investor with a holding period of essentially forever, but in the last 6 years or so, I've done more sector rotation than ever because of the series of mini bubbles that we've experienced. But right now, I'm selling all of my smaller AI assets and moving to cash. I am selling high. I'm keeping a few pick and shovel AI plays, mostly NVIDIA and a few defense and intelligence related stocks. This is because I firmly believe that no matter who's in power, the authoritarian national security state, essentially our collection of three-letter agencies, is only going to grow in power and influence. Now, the economy is slowing down. We are reaching the normal end of a credit cycle. And at some point in the near future, we're heading for what I suspect, in actual mathematically verifiable terms, is going to be a relatively shallow recession of only a few quarters. Meaning that over several quarters, we're going to see a total contraction of the economy of around 2 to 3%. But the reaction of the stock market is going to be a lot greater than 2 to 3%. And this is going to represent an incredible buying opportunity that's a lot like what we had at the beginning of COVID. Most of this is going to be for psychological reasons, just like it was for COVID. We haven't seen the end of the credit cycle be allowed to die a natural death since before the dot-com era, and I expect that the initial panic is going to be wildly overblown. I also suspect that the rotation of dollars from high-risk AI assets to very boring value stocks is going to be wildly misinterpreted by the non-institutional investing public, which is going to temporarily magnify losses in the stock market. This will matter more in the past because we've seen more stock market participation by regular folks like you and me than we ever had in the past. Long before the dust settles, when things look their bleakest and you start seeing news stories about folks on the trading floor of the New York Stock Exchange bursting into tears, I am going to start to buy. What I'm going to buy is a sector ETF focused on AI. If I can find one that is not market cap weighted, that is what I will buy. Because I already own NVIDIA, and any market cap weighted ETF would just be dominated by NVIDIA and Google. So why not individual stocks? Because I don't know what companies are going to thrive, and you don't either. Technological revolutions subvert expectations of investors every single time. For every 20 stocks that survive the initial AI bubble bursting, 19 of those are still going to fail to meet investor expectations. 1 out of 20 is going to outperform by such a degree that it's more than going to make up for the disappointments. Now, I've already made my money off of the initial AI bubble. Now I plan to not lose that money and to actually profit from the AI revolution. AI is here to stay. I am certainly leaving some gains on the table, but that's okay. It's okay for you too. It's okay to sell high. Think long term. Very few individual AI investments are going to survive the AI bubble, but AI is here to stay and it will radically transform our lives. Thank you very much and have a nice day.